All right. Thank you, everybody, for joining us today. We appreciate you taking time out of your busy day to participate in what I think is going to be extremely valuable information. And people are still joining us, so I'm going to get some housekeeping out of the way while that is still happening. Basically, please don't hesitate to ask questions. We encourage that. We would like you to put them in the chat before you forget what they are. We will give time either while we're talking, we'll be answering some questions in the chat, and then also we'll give time at the end for some Q&A to kind of go back and forth with as well. And we'll do our best to kind of audibly go through the questions if they are also answered in the chat, so that they're part of the actual audio recording. But yeah, if you could humor me, where are you in the chat? Where are you zooming in from? And maybe just one bullet point of what you hope to get out of this call would be super cool. I'm here in Orange County, California, personally, and it's 9,000 degrees outside today, but it's all good. So, but yeah, we are here to talk about demystifying what's called private credit. And maybe you know what private credit is, maybe you don't. Maybe you don't even know that it needs demystifying, but we're going to demystify it regardless today. And we're going to talk about exactly what it is, how it works, and why it matters. And I think all three of those questions will be answered very, very thoroughly by our guest here today, who I'm going to introduce momentarily. My name is Brett. I'm a self-directed IRA solo 401k consultant here at Sense Financial. And we're not a fiduciary. We don't provide legal or tax advice, and we are not here. None of our guests are to provide financial guidance or advice or provide legal advice. So if you need such help, please seek out the proper professional. And just a quick moment about what we do here. We've been in business since 2010, and we're a boutique financial firm that specializes in self-directed plans with checkbook control that allow you to invest efficiently without transaction fees and per asset fees, and control of the transactions without having to go through a custodian and wait for that to take place. Our clients love us. They seem to, at least. Most of our clients come from referrals. Most of those referrals come from existing clients, and we do have 5-star reviews on all the major websites that you can check out where reviews are held. We have assisted over 7,000 clients, set up over 8,000 different types of self-directed plans. And then I said this already, most of our clients come from referrals. Some quick benefits of the IRA and 401k, because I do want to get out of the way and let our guests speak here as soon as possible. The whole point of self-directing your retirement funds is so that you can obtain what I call true diversification, right? You can think you're diversified, quote unquote, if you're just in public assets in Wall Street, in stocks, bonds, mutual funds, and ETFs. And to a certain extent you are, especially if it's mutual funds. But it's still public assets. It's still the stock market that you have no control of. You're basically putting money in there, and it's not the roulette wheel in Vegas for sure. It's a lot better than that, but you still are leaving your retirement up to external sources, people that you don't have any communication with, most likely, and you never know what's going to happen in the world that's going to affect the emotions of people that have money in the stock market. People sell when they shouldn't, and they buy when they shouldn't, and they try and time the market, and it rarely works. And so if you can truly diversify with self-directed retirement plans, that's what we're here to talk about today, at least one of the options that you have. And they can be traditional pre-tax, tax deferred, or Roth, tax-free. That's my favorite way, right? Would you rather pay taxes on the seed or the harvest? Obviously, the harvest is not what I'd rather pay taxes on. And then if you do buy real estate in your retirement plan, you can get non-recourse financing. We can talk more about that later. And what is that? That's fascinating. Who had access to do that? Aurelia, can you figure out deleting that? That's so fascinating. Never saw that before. Okay. Thank you. So you do have, I talked about checkbook control already, and we do offer, so we do self-directed IRAs, checkbook control, and then we also do solo 401k. So with the solo 401k, of course, you can contribute up to literally 10 times the amount of an IRA. And we call it the ultimate retirement plan for that reason and many others that I won't get into today because we don't have time. But some of the more common investment options are real estate, commercial, residential, private lending, crypto, precious metals, tax deeds, trust deeds, all of the above. And so the IRS only tells you what you can't invest in, which is a very small list. And then we talked about the true diversification already. Don't put all your eggs in one basket. But we're here today to talk about to give our guest speakers the microphone here, rather. And I have to apologize because I didn't have my trusty intro. So Erik, I'm going to actually let you take over and introduce yourself today. But let me just say this: Valhalla Capital Partners and Sense Financial have it's been a great partnership. We've introduced people to them, and they've introduced people to us, and so we want to honor that partnership by giving them the floor here to introduce to you what they offer in terms of investment goes. And of course, buyer beware, do your own due diligence, but we're here to answer a lot of the questions that you might have about what private credit is. And without further ado, Erik, take it away, my friend.
Okay, thank you so much, Brett. So let me start with first asking, can you see a black slide without any graffiti on it?
We can,
Okay,
yes,
very
thank you.
well. And since you could smile when I asked, I know you can hear me as well. Thank you so much, Brett. And yeah, I can vouch for happy customers. We have a lot of LPs in our fund that started investing cash with us that then wanted to use their self-directed IRA, and many of them didn't even know what that was to start with. And we said, go talk to Brett, and now they have their second account through Sense with that checkbook control and have invested in Valhalla. So my name is Erik Berggren. I am the co-founder and the CEO of Valhalla Capital Partners. What we're doing here today, and I saw in the chat, many of you were actually asking for demystification and better understanding of what private credit is. So we are basically going to run more of an educational webinar here now. So please ask more questions through the chat, and Brett's going to help with moderation of those. I need to say that this webinar is not investment advice or anything of that nature. This is for educational purposes only. We are a fund provider, and if you are an accredited investor and want to learn more, you can contact us, and then we'd be very happy to talk to you more in detail about what this potential opportunity could be for you. And it's hard to know exactly where you're at, but if you're reading mainstream media and business press, you're going to see that private credit is everywhere in the headlines. But the reality is that private credit is just basically lending. And if we look at this and take a step back and really talk about what it is and start demystifying this, banks and all these constructs and all this regulation and all that, that's actually the new kid on the block. Lending has been going on since, as far as we know, 3000 before BC. And it's important to know when it's reading and learning about this, there's a lot of jargon behind it. But bear in mind that point number one is that it is truly just private lending. And the market is quite large too. So if you think about that, if you're lending something to someone and you have something as a lien, as a security for that lending, that can be a very different lending. And it's estimated that the total market in the US today is about $3.5 trillion. And as you can see, about half of that is actually lending directly into mid-sized companies. And when you're looking at the negative press that you might have seen, that it's in liquid assets and it's full of trouble, etc., it's typically in this bucket. And what has happened here is that it's been a lot of lending going on to software companies, and they were borrowing when they had a certain amount of revenue, and they thought that was a very predictable monthly or annual revenue stream. But as they became under pressure because a lot of their customers started replacing their software with AI and running that directly, the whole ability to pay back in these loans got really soft. What we are doing is not that kind of lending. I'm not going to go through all the details here, but we leave it as a slide so you can go in and take a look at this in more detail to see what it is. But where we are in the real estate debt. And even more specific, we are in residential real estate and residential real estate in Middle America. So it's trickled down from this 3.5 trillion to more like, if I can go back here, more to about 120 billion dollar estimated in private lending. And it is definitely growing. So as we're framing this and what we're talking about here today, it is in residential real estate, private credit. And that is two kinds of loans, really. It's one to build, develop, and enhance properties, and another is to leverage existing properties as a landlord. And that's the kind of lending that we're doing. And why has this grown so much? And why is it still growing so much? It's because on the supply side, banks really pulled back. And it is both because of regulatory pressures from oversight committees, and where they actually have to have a capital coverage. They can't lend everything they have on the balance sheet because of that. Interest rates spiked up, and banks themselves wanted to have tighter underwriting of this. So in many cases, did they issue loans at an 80% loan to value, but as they mature, they are only redoing them at 60 or 70%. So it leaves like a vacuum and a need for capital just because of that supply constraint. And on the demand side, why this is exciting, and where I always consider this when I'm doing some lending or going into business in general, is there like an underlying demand for the product that is being offered? And it is an ongoing borrower demand. And that is because the particular lending that we support is only done in areas where there is growth. So we are, supporting this to a fund that is doing this lending in Middle America, but in places where people are moving into. And I don't know if you can recall when you've been trying to take a mortgage or borrowing money from a bank, it is not easy. It is very, very difficult. And there is almost a torturous amount of paperwork and documentation, etc., that needs to be provided. And then it can still take a couple of months, and you can get change of terms or just no thanks, we don't want to do it. That does not work for a developer. They need speed. They need a trust and know that the money is going to be there when they're close on a property or they undertake a development project. So that need for speed and flexibility and the ability to underwrite much, much faster and in a more streamlined fashion has been driving a lot of the growth in this area. Brett, do we have any questions we should address now, or should I continue laying the background here?
Keep going.
Okay. I didn't know if you're going to do that graffiti thing and give me a hint, but so
I should. I
what?
won't. I won't. I won't be brutal with what I say though on there. So
So basically, what I'm illustrating here with this picture is that the private credit fund, the actual lending, and they are not a bank, they're not regulated by this, but think about this as a lending operation, kind of the lending part of a bank. They need capital so that they can lend. That is what we do. So what Valhalla does, and what the opportunity is for an investment as an individual, accredited investor that is to invest with Valhalla, where we pool this capital and manage this and make monthly and bigger investments into the underlying fund, where they in turn are doing the underwriting of loans and manage and service these loans. So they provide capital and they get fees and interest back in return. They are doing that in a quite profitable manner, and that means that the investors from there are getting paid back a yield from their investment. And this is basically something that is happening on a monthly basis. And in this particular case, the way it works is that we're providing capital every month and the yield is coming back every month. So it's very liquid and it goes pretty fast. But this is the shielding from the actual lending operation. So this is way more of a passive opportunity and an opportunity to take part of an existing lending operation without actually being in the details and do any of the underwriting and that yourself. We have certainly done some of that, and you can be lucky, but it's hard, and if you're not doing it at scale, it's pretty expensive. So the reason investors are considering this private credit part, the asset-based private credit part that we're representing here, is they're looking for income. And what I was talking about in the structure we have, it's basically you can get paid monthly. So you're putting deposits in and you're receiving income in a more predictable and structured way. It has nothing to do with the underlying valuation of an asset. It has just to do with, at the end of the day, borrowers are paying interest and fees on that, and that is what your capital is being used for. The other thing that's really important and a big difference from a lot of other, if not all other investments, is that you sit higher in the capital stack. So if you're investing in equity, and that could be in the stock market, or that could be basically buying real estate, anything that is equity of some kind, you're an equity holder. You're at the mercy of that equity's valuation. So if that equity goes down, your investment value goes down. And the way it works with credit is that you have, with the credit, just like when you have a car loan or a mortgage, if you're on that side of it, you actually have to pay a contractual amount every month or every quarter or whatever the contract is. And as being part of this, as an investor and being on the credit side, that means you are being paid first. If there is a problem, the equity holders are going to get to take that hit. And in this case, this is also collateralized by a real asset. So there is actually a real first lien position and typically a 30% equity position in the underlying houses. So should the borrower fail to pay it back, then there's equity in there. So the loan can be secured that way by repossessing the property and sell it to someone else and pay back the loan. That's how it sits in that capital stack. The other thing is also, of course, I'm thinking about that omelette slide you were showing, Brett, with all these eggs on the floor there. This is true diversification for a lot of people. And we, as many of our investors, own real estate. They are private landlords, and some of them have used self-directed IRAs to do that. And this is definitely a very good complement to this. I can't give tax advice, but there is one set of tax structures around direct holding of a property that could be very beneficial. But typically, we have seen very compressed cap rates and not that high yield, plus all the operational risk, etc. But complementing those together with having passive structural income that is contractually to you, that has been a really good diversification play. And of course, this is something that since it's actually income, and if you're thinking about this from a retirement fund, whether you are in an age where you're eligible and you want to take money out and live from, or if you are on the other side of that, whatever it is, 59 and a half or what age it is, and you're still just putting it in. The beauty of a structure like this is that you can allocate capital into it, and then you can actually get the yield coming out of that, and that yield is what's used for paying bills. So you actually don't have to sell off assets. So that means instead of burning down the capital that sits in the retirement account, the capital stays and it can grow even, and whatever it spits out on a monthly basis is what's being used for paying bills. And if a system is being set up that way, then you're not reducing capital, and you're not going to run out of that as you're growing older. So that's what I wanted to share in terms of why investors are really looking into this. Are there any questions from the audience we should address, Brett?
Not yet, but what you just said was one of my favorite points you made. I think you were in the Bay Area the other day, or maybe a couple months ago, and you said pretty much exactly what you just said. And it's like, yeah, protect the capital. Well, let me back up. What a lot of people do as they get closer to retirement is they put their retirement money, IRA money, into, like a bond fund or money market, something really conservative, because their financial planner or somebody that, thinks they know what they're talking about is telling them to protect the principal, right? Well, how about we protect the principal and we increase the value of the account, so that when we do take distributions after 59 and a half, we don't have to touch the principal. We can just live off of the earnings. And it's hard to do that if you're getting 3% in a money market fund. So anyway, just I want people to kind of have maybe a little paradigm shift with what you can actually do when you're earning a fair amount of interest in your self-directed plan. That's hard to get, honestly. It really is in the stock market. I mean, yeah, it does okay over a long haul, but it's not going to touch a lot of what private credit has to offer and other alternative assets as well. So anyway, I'm done.
Yeah, no, I mean, that's a very important point. And since this is an educational webinar, we can't talk about the actual returns that we have been able to produce, and how the model works for what we do. But if this is something you're interested in and you do not think that what you're getting from bonds or stock market and so-called high yield savings accounts work for you, and you want to learn more about that, we would be able to have that conversation with accredited investors more one-on-one. Okay, if there are no more questions, I assume this is clear as mud, and I will continue. And this is again, though, a little bit why this might be so confusing for people, because it's, oh, private credit, and we've heard certain funds not doing so well, and it's many of the really big ones. Right now, there is a lot of capital in private credit that actually goes in to fund the build out of AI data centers. That's where a lot of money is going in now. The negative headlines has been a lot on the corporate lending that we talked about from typically in the software companies. That's where it's been a lot of challenges. But advice number one here is like, when you're thinking about this and you're looking at different allocations, you have to go beyond what private credit is. That doesn't say anything. Again, that's just lending. What kind of lendings? Because whatever the strategy is, that dictates, of course, the risks and what your money is being used for and the outcomes you should be expecting. I went two slides. No, there we go. Sorry. Hard to click properly. And headlines get this wrong again when they're talking about hard money. And that's like difficult to dangerous. Like, again, no, we've been doing lending for a long, long period of time. Just because banks hide behind 2 months of red tape and a torturous amount of paperwork and all that, and it doesn't make it any safer. It's actually, I personally had a lot of experience with that, where it gets so bureaucratic and convoluted that you kind of lose control. So what actually matters here is that the structure of the lending, the underwriting, and the discipline of this is what it does. So the first, look at the actual lender. So where you deploy capital as an investor, look at how do they lend? What is their track record? What kind of failure points have they have? How do you make sure it's not a single point of failure, etc.? And the second part of this is that what collaterals? Would you rather lend to someone that has a someone's primary home somewhere in middle America where someone is actually need to pay the rent or that mortgage, or they will be sleeping on the street? Do you prefer to lend to something that is that strong of an asset, or to an unknown company's revenue stream that is being replaced by AI? Those are two very different things. So you need to understand both the lender and the underlying collateral. And of course, the borrower. And this is very simple supply and demand, because if the lender is in a strong position and if they are operating in markets where there is high demand for their products, then it's basically a lender's market, right? They can choose to undertake only underwrite only loans that they feel good about. They can say no to potential borrowers that doesn't fit the bill, and they can, for example, then do this only to borrowers that have a strong track record or have something in as an asset protection there. And the other thing here is, just because it's private does not mean that it should be opaque. If you can get and invest with someone that provides a high degree of transparency, that can really explain the strategy, what they do, how they lend, and get reports on this on a monthly or a quarterly basis or whatever you want to do. One of the things that we talk to our investors a lot about is, you don't have to answer phone calls at 2 a.m. from leaky toilet or chase down a tenant who doesn't pay the rent. This is truly passive. But that doesn't mean that you don't want to see how your money is being used and how it's growing. And if you don't want to, you can obviously sit and just collect your cash or look at the monthly statement as it's growing if you're doing that. So that reporting and the performance visibility, if you're working with someone who's good in this, they will provide that. It is not a black box. And understanding why your returns are higher than what they are in another fund is important to understand, because you need to understand the structure and the profit mechanism of what's actually going on. So there is definitely something that a lot of headlines that it is not opaque, and there are operations that are not. And obviously, you can choose where you want to invest yourself. So with that, we, as part of being educational with this, we wanted to give some pointers and some help to guide how to actually evaluate this. So the first one is that I've been talking about that quite a lot here. It's like, what kind of private credit is this? What is it that you're actually lending for? Are you lending for speculative purposes to build something that needs to proven to be right? Or are you lending into something that's already existing and working? What's the underlying part there? Who is the borrower? Is it an individual with skin in the game? Is it a company with some hired executives? Or who is actually, at the end of the day, going to pay? And what secures the loan? So you understand what kind of lending it is. You understand who the borrower is. What is actually the underlying asset that protects if things go wrong? The stuff we're talking about in what we are doing is residential real estate, but there are many different things this can be. What is the duration of these loans? Are we locking our money up for 5 years? Is this like long-term loans that is going to support some operational growth, or is this a 6-month construction loan term? The duration of the loan is not a factor in itself to say it's good or bad, but the longer it is, the more things needs to stay true for that time in order for that not to become a risky investment. So generally speaking, shorter duration of the loans is typically better because you recycle capital. And what's the downside protection? It's of course combined with number two and number three. Because if you're doing this lending, it's totally legal to just lend to someone blanco loans. And that's not then there is no asset underlying this. But you need to go a little bit deeper than just understand that there's a lien on the property, because you need to understand how much equity cushion is in there and what's the liquidity of taking that asset back and being able to sell it to someone else. And back to the borrower there again, what happens to the borrower if they default? If that's an absolute catastrophe for them and it's like personal guarantees and things like that, chances that they do that is much lower than if it is just a professional manager that can just walk away and then the company is bust. So really understand what can go wrong, and the downside protection of that is important. And of course, you want to know who you're working with. What is the manager's track record? Are these people that you would trust? Do they have their own skin in the game in this? I would always encourage anyone who's doing any private investment, whether it's in credit or equity, to always ask the first and simplest due diligence question first. And I always do that if I do it. Okay, what do you have in here? If you want my money to support your venture here, how much of your own money is in there? Are you losing before I lose as coming in with money? And that very simple question to see and understand who you're dealing with is often overlooked. And when you actually start asking, you'll see that there's actually a lot of funds and opportunities where it's just a professional or a manager who wants to invest other people's money, but they don't have their own money in there, and their own money there is being at risk first. And combined with the downside protection there, it's one thing that there is a personal guarantee or that there is an equity cushion and that there is a lien on the property. But does the manager actually have a process? Do they actually know how to handle default? Are they going to figure that out if things go wrong? Because things will go wrong. There is no way you can lend at scale without loans don't work out as they are written. So knowing and understanding that there is a process for that, and that this is not something that is like panic mode or not know how to handle, but it's actually part of standard operating procedures for how to do it, is really important. And then the last point of this is that just make sure that you get enough transparency and reporting so that you feel comfortable with this. I am by no means suggesting that you need to be an expert in lending or the underlying things. Let the operators do that, let the manager do their job, but you should know how your capital has been used and why it's producing the return it does. And you should not feel that you are not on a need to know basis there. So if I flip this script and talk about what really to look out for, is the strategy description is very vague. If the person or the company that you're investing with here can't very clearly articulate what they're lending to whom, what their lending box is, etc., that's a no-go, because then you don't know what they're going to do. That sounds like it can be very opportunistic, and of course you can always be lucky, but the point here is to actually reduce variability and chances for things to go wrong. You want that structural predictable income. And I talked about the weak GP alignment. If the manager, the general partner, does not lose money before you do, if things go wrong, and if they only make money when you make money, you have strong GP alignment. So just ask questions around that and make sure that there is some alignment. So you literally are in the same boat as the person that's going to be the steward of your money. And of course, if if the manager is not talking about any downside risk, that's not being talked about or addressed, then it's probably not even been thought of. And it needs to be. When we're investing, we're looking at long cycles, and we make assumptions of the world. And as we know, the world changes, and sometimes very fast and very dramatically. Playing out those scenarios and understanding what can go wrong, and maybe ask the question, what needs to be true in order for me to lose my principal? It's one of my favorite questions. So when I do my own due diligence, I check for the GP alignment first. And then, of course, I want to understand what I'm investing in. But I want to be able to have an intelligent conversation about what needs to be true in order for me to lose my money. And if that is, in some cases, you're going to lose your money right away unless something gets true to happen in the future. That's typically what venture is. You just put money in and hope that world is going to change in a certain way and customer behavior in the future is going to be in a certain way. Then you get a payback. Credit is the reverse. This is already going. So you ask the question, what needs to change in order for me to not get my return? And having that conversation is important. And the, if you're dealing with someone who is not actually providing clean, crisp reporting in a timely fashion, then I personally get a little nervous. Like, what is actually going on? I would like to know. I like passive investments, of course, but I would like to know that it is not just gave money to someone and they run off and do something I have no idea really what, and then maybe I get something later. So, and that's also there's no clarity on what is actually the collateral, and if I want to get my money back, what are the terms? If those are clearly articulated and understood, then I know what it is that I am getting into. That is very important. And the last point here, if there is just uh, only talk about how high the returns are, but they can't explain why those returns are so high, that if you don't understand or if the manager cannot articulate the structure, that is something I will be very about as well. And Brett, now I'm sure it must be some questions because we've done a lot of do's and don'ts here.
There are a few, yeah.
Good.
I'm going to start with one that's kind of relevant to the slide you're on right now. And this person is asking, is there a third party entity that we can check on this kind of company? They can say whatever they want to say. How can we verify what they said is true? And then Caitlin did answer that there is an audit available. And this person came back with, is that public information or I have to ask for them to provide, meaning you guys?
Okay. Yeah, I can explain this. So what I've been talking about here is in general. There are many, many different ways where you can invest. So now I'm going to talk about our particular fund. We provide a lot of one-on-one education and information exactly how everything looks. We provide a detailed track record of how the fund has performed. We're now in its third year, and we show per month what's going on. We verify that the investor are an accredited investor and understand the logic and structure for what it is that they could invest in. Then we open up Pandora's box. We have a full-on data room where we provide all details, all legal details, all risk details, and the full audited financials, etc. But what we don't do is we don't have that as public information. And what we have also found is that it's overwhelming. And if investors don't follow some kind of this little thoughtful what it is. We try to guide and walk through this. And when we see that there is good understanding and there is intent to invest and want to learn more, that's when we're doing the full disclosure package.
Great. The only other one, you kind of touched on this earlier, but maybe an opportunity to expand on is Rob is asking, what has been Valhalla's average return? Well, they're saying over the last 5 or 10 years, but what has been the average return on private lending?
Yeah, so I can share because this is historical data, and we're just going to be careful in all these educational things. So we cannot say that this is going to be true forever. Uh, but we have returned over 20% net to investors, including the investors get a 12% pref. So our LPs get to eat first, and we're doing this on a monthly basis. So 12 makes one. There's 1 percentage point per month that goes to the investor first. And then the upside above that is split with Valhalla and the investors. And we have produced over 20% for this, and we are currently on track. Again, that is up, including June data, so the first 6 months of this year, over 21% net to investors.
Yeah, that's great. That means that if I put $500,000 in the fund, I know there's no guarantee of future performance. I get that. But if it's 20%, that's $8,333 a month that I could expect to come in or hope to come in, right? And, if that's not in a retirement account, then presumably someone could live on that money. I mean, I just want people to think about this for a second. There is not a piece of real estate on planet Earth that you could buy for $500,000 that's going to get you an $8,000 monthly return. It just does not exist. So, just as you're thinking through what to invest in, um, I just I'm not making a financial recommendation because I'm not qualified to, but I encourage people to consider private credit as part of their portfolio for a lot of reasons, but partially for what I just said as well. So
Yes, that is correct. And you have to set the assumptions for what return you expect to do. But if you're going with the returns that you're talking about, Brett, if this sits in a retirement account and you're still in the accumulation phase where you haven't started taking any of this out yet, you can also, it's very simple math. We have it on our website, a very simple calculator where you can make your own assumptions of how much principal you put in, what return you're expecting, how long you want it to sit, and then you toggle on or off monthly compounding effect because the offer we have is being paid on a monthly basis. So if you're actually not taking the cash out, it is being reinvested on a monthly basis, and that produces an exponential growth curve. And this is what we have seen when we've been working with you, Brett, that many of our LPs came in and they put in cash first and just wanted to do that. And then we get a little deeper and talk to them and discuss more the opportunity of reallocating a traditional 401k or whatever they might have from the stock market or something into this. And that's where you have helped many people set it up, because if you play the math and you do that, and if you're having an 18-20% return like that, you're doubling your money every 3 to 3.5 years, depending on exactly what that is. So that's why you need to set your assumptions and do that. But if you have 10 years till retirement, or call it 10 and a half or 11 to be a little safe, if you can put in, let's say, $500,000 of retirement savings, that is then one doubles again. So then you have two, and then that doubles again, then that would be four. So $500,000 would, if that return profile holds, be about four after 10 years. So if you're lucky enough and you can do this when you're, say, about 50, and then you want to live off of that when you're 60, if you actually have four and you start taking cash distributions from that, so you start living off of that, 10% of 4 million is 400,000, 20% is 800,000. If you can be somewhere in that bracket and have that kind of income while your principal is still there, you're actually not chewing down from it, your money is just working and it produces that yield, then you have income from that retirement fund without compromising your principal. And one thing that is unique with our offering and why this has been such a popular thing is that we can actually be flexible with this. So every LP chooses how much he or she wants to reinvest versus how much they want to have in cash. So most of them are actually then putting money in, letting it just sitting and grow with a monthly compound. And then at a point in time where they want to have cash, they're actually getting cash out. I'm gonna share a story here, if I may, unless there aren't any more questions there.
there are, but keep going because they're gonna lead in. You're gonna lead into them, I think, naturally. So
Okay, so Elizabeth has been very generous with us. So this is actually a true story. The numbers are there, and this is actually she. She did not want to be I don't know if she gave me the permission to tell her exactly how old she is, but she fits that kind of profile that I was talking about. So about 10-ish years to retirement. And she did not want to work for the man anymore, so to speak. She did not want to have a W-2. She has been very successful with that, and that's how I got to know her. She wanted to run her own consulting company. And with that means that she can have high income and she can have no income. It's very lumpy and it's just depending on if the customer wants her services at a certain point or not. But she wanted that. She sold her house in San Francisco and she took $500,000 of that and put it into our fund. And then she took 350K of her um, retirement fund that was available for making a move, and she put it into our fund, and she saved 100K for whatever taxes and all those things. And what she's doing is that she's sitting and letting this just roll and grow. And she did the math and she set her own assumptions and said, okay, great. And she really had specific goals. She said she never wants to look over the shoulder for money. She never wants to be a burden for her kids and family in the future. She want to make sure she has all the cash flow to take care of herself, even if there would be whatever medical needs in the future. So very important for her to make sure she's not a burden. And then as a bonus is that it's great if something is left for my kids, etc. But the main point is I want to live free and I don't want to be a burden to anyone. And what I think is so cool that happened, and this is just a few months ago, I think maybe it was even last month, she just reached out to us and says, hey, I remember you said I can flip this to cash distributions monthly if I want to, right? I said, yeah, absolutely. We can do it from next month. Is that what you want to do? And then she shared some a little bit more personal stuff, but she needed cash flow for about 3, 4 months for some medical stuff that she wanted to do. And she said, I don't want to sell anything and all that, but if I do that, can I just get monthly checks? So yeah, absolutely. So we literally just flipped the switch in our system, and now she's getting a monthly check. So her 500K account that she put in uh, was growing on a monthly basis. Now it's just parked. She takes cash out. And then she said, once I'm done with this and don't need it anymore, can we flip the switch back again? I said, yeah, we sure can. So she had the 500K, and I don't remember exactly what that grew to, but it was, I don't know, 550 or so. And then she's now getting the monthly return from that. She's using that cash for the needs she had, and then she's just gonna flip that back. The green box here with her IRA account, that's basically just gonna sit and grow for, I think, an estimated 12 years. And she doesn't need the cash flow right now because she's doing well with her consulting part, except for these months when she's going to do this extra thing. But having the flexibility for her to just stop, whether it's the customer that suggests she's not doing consulting anymore, or if it's her choice, she had the opportunity then to just actually start, to your point, Brett, if you're getting 100-ish K per year out of just that cash account, and you still have your principal, that is plenty of cash flow for many, and many people are very happy and can live quite well out of that. And to your point, if you do put 500K into a real estate asset, it's not realistic to think that that's going to give you enough of 100K cash flow per year, at least not in today's market. So I just wanted to share that story because this is, very real. So, final takeaway from my side here, it's not a buzzword. It's not dangerous. It's not a silver bullet. It just means lending. It's 3.5 trillion of this going on in the US right now. We play in a very small space and we provide opportunities for accredited investors to participate in this without actually being an operator and doing the work themselves. So that's what I got. Over to you, Brett. Is that you now?
Yeah, that was me. I was just seeing if I could
I'll
actually
stop
do that.
sharing
So that's a terrible yay. That says yay, by the way. But anyway, all
there.
right. Thank you so much, Erik. What a great presentation. You certainly helped. Yeah, I mean, I understand more than I did before, and I thought I had a pretty good grasp on things. So appreciate
hmm
that. There are a
hmm
few more good questions. Let me just, I'm kind of scrolling through here. If people want to give you a try, is there a minimum amount? That's question number one.
So we only work with accredited investors. Our minimum is 250. We have allowed for some people that have an intent to be there with 250 or more to come in with a smaller amount, but there is no such thing as a trial. We are providing a very, very detailed overview and disclosure of everything that's there. And if this is an investor, it's coming through Sense. We have quite a few that have done the same. So if it is at the last minute, we don't want to bug or ask our investors to spend their time, and we don't share any information from them unless they explicitly give us permission to, like Elizabeth did. Uh, we could provide references, which we have done in some cases. And then we would do that with someone who is in a little bit more in a similar boat and probably also invested through Sense if that's where you're coming from.
All right. And then Javier says, you mentioned a 20% return. You mentioned 1% a month, and then the rest is shared. So I mean, maybe just clarify, when is the shared portion distributed?
Yes, our particular offer, and again, that is only available to accredited investors, but it's a very simple model. So on an annualized basis, this is what it is. You're getting a 12% preferred return on an annualized basis. That means 1 point per month. There are no other fees. There's no sign-up fee. We take care of all the operational and reporting fees and all that because we are so confident that we're going to deliver more. If we don't, we actually keep you on as a customer at our own expense. We have a few $1 million of our own money into this fund and have had that for years. And we are capitalized to run that even if it's a down scenario. When we are saying north of 20%, that is the historical performance net to our investors. So yes, you have a 12% pref, but our investors have enjoyed 20% per year.
And the shared portion is distributed on a monthly basis also. Is that correct?
Everything is monthly in our fund.
Yeah.
Yes, there is no annual true up. We use the annual returns because that's what you can use to compare to other investments. But what we would like to do is that if you are an accredited investor, and we can verify that, we would prefer to have a one-on-one meeting with you and share exactly how that is. And Brett can, after this video or after this webinar, share a 10-minute video overview to the accredited investor if you have that interest. And the reason I am a little reluctant to overshare here is that we are in a very heavily regulated market. So we are regulated by the SEC. We can only have these conversations with accredited investors. And that is why we prefer to do that in a little bit more of a one-on-one setting. But hopefully I was clear on explaining what the difference between the 12 and the 20 is.
Yep, that makes sense, I think. Let's see, someone asked how to schedule a call. They have your calendar. Okay, well, maybe just explain what accredited means. That might not, maybe not everybody understands that. Someone's asking, how do we
Oh,
get
okay.
accredited? So,
Yes. So that is a legal Uncle Sam term. What it means is that you need to have $1 million worth of net equity outside of your primary home or $200,000 of steady annualized income, or I think it is 300 as a couple, married couple combined. So
yeah.
if you qualify either with having that much wealth or having that much income, you are getting accredited. And the way we do it is that we either accept a letter from your CPA or a tax attorney, or as part of the process to subscribe and start working with us, uh, you get sent to a portal that so we don't see your actual financial data, but you have to upload bank statements and or tax returns to a third party black box. And if they say, yes, this person with this social security number has this, then they basically just do a green thumbs up and send that to us, and then you're accredited.
Perfect. Sam, pre-tax and post-tax money inside of a retirement account is part of your net worth. So the answer to your question, can we use pre-tax and post-tax to get accredited? It's not really getting accredited. It's more, does it count towards the accreditation process? And the answer is yes, it is part of your net worth. So yeah, you bet. Okay, any other questions? We'll give it a few more minutes here before we part ways, but this is great info. Appreciate you coming on, Erik, and Valhalla is doing great work. Look forward to continuing to, help people with this information and introduce people to you. And yep, Erik just put his email in the chat, so you guys can reach out to him or Caitlin as well. Okay, Javier says, do you accept mixed funds as part of the investment 401k and not? Oh, you know what, Javier? I'm sorry. You did ask that a minute ago and I missed that question. I forgot to come back to it. So there you go.
Okay, so
And I can address
Javier,
this too, because this has to do possibly with a little bit of prohibited transaction territory. But go ahead. Go ahead, Erik.
yeah, what I was going to say is that in terms of qualifying to do business with us, if you want to take 150 from one account and 150 from another, and then you have 300, and then we take you on as a client, that answer is yes. But if part of it comes from your personal money, then that is one account with your personal social security as one account. And then if it comes from a trust or an LLC or something else, that's a separate account. So technically, you would have two accounts with us. You cannot, we cannot take two tax numbers into one account. So they have to be in separate accounts,
Yeah.
but we can do
Yeah.
that.
That's the short answer of it. You could potentially get creative and create a multi-member LLC with one member being your retirement account and one member being you personally. I don't recommend that because it's, first of all, it's not keeping it simple, and the accounting is tricky, and you increase the chances of accidentally committing a prohibited transaction with an IRA that would distribute the entire plan. So you want to just keep everything separate is the easiest way to answer that question. And Erik said that they could help out with that as well. So there you go. Cool. All right. Well, any last words from you, Erik?
I would love to talk to you guys that have an interest in this in a one-on-one. I put my email in there, Erik@valhallacap.com. We're also present on LinkedIn. And if you are an accredited investor and if you are curious about how this works, how this could work for you, would love to have a one-on-one conversation with you. And plenty available, no travels next week. So just let us know what works for you and we can have those conversations.
Excellent. And yeah, if you want to share that 10-minute video with us, we'll push it out to the audience as well with the recording
Yeah.
of this. So,
Yes, let's do that.
all right.
So
Okay.
thank you for the opportunity and thank you so much, guys. I didn't get a chance to actually meet and know you, but I see the curiosity of all the questions. So very much appreciate that and looking forward to speaking one-on-one with you guys.
All right. Thank you, everybody. Take care.